Morning, everybody. Hello, and welcome to this legislative update intended to prepare you for the new tax year, covering everything to do with payroll that you might need to think about or that will crop up during this transition period. Um, Hello, for those of you who haven't met me before, my name's Fiona Smith. I am the Payroll Training Manager at CIPP. So I am responsible for our training products. So I deliver training courses to payroll professionals of all different types, from all different types of organisation. And before joining the CIPP about 6 years ago, I worked myself in operational payroll. So I've got a decent appreciation of what happens in day-to-day payroll operations. And I'm pleased to say that this year, touch all the wood in the world, we have a fairly steady year when it comes to payroll operations and updates for you. Um, Quick bit of housekeeping before we jump straight into the content. So we've got an hour together this morning. I've got a presentation that I'll go through for about 45 minutes, just covering all the different areas of update. I'd encourage you to ask questions as we go through. We will have time for questions at the end, about 15 minutes for a Q&A. So please say hello in the chat and pop your questions in there. I'm hoping I'll be able to see them as I go through. It might be that I might ask you to resubmit them if there's lots of chat as we're going on, as I will be picking out the questions myself towards the end of today's session. Quick reminder that you will get a copy of the recording for this session and a copy of all the slides. So don't panic with scribbling down notes. You will get all of these numbers after today's session. So without further ado, let's jump in to what we're going to cover during the session. So we're going to be looking at those key areas that are changing coming up to 6th of April, the new tax year. So we'll cover some of the statutory rates and thresholds, including changes to income tax, national insurance, and we are going to cover the changes to statutory payments, including the headline change this year, which is the changes to statutory sick pay. So I'll be looking at what's new in the new year, and how to handle that transition period over the change in rules. We'll then move on to some other payroll related issues, looking at changes to the minimum wage, the increases, changes to pensions, and changes to reporting of benefits. And then we'll try and cast a little crystal ball to see what's next and what should you be looking for further afield, just to keep on your radar that may not necessarily impact your processing directly from April. Hopefully that sounds like what you've signed up for. If not, you might be in the wrong place, but hopefully you'll stay with me anyway over the next hour. So first up, looking at tax thresholds. Now, as I say, this year we've entered into a period of fairly steady progress, or kind of a freeze, really, where it comes to tax and national insurance. As part of the autumn budget, it was confirmed that the thresholds for income tax and the personal allowance, which have been frozen for a number of years now, will continue to be frozen until April 2031. So, on one hand, that's quite positive because we know where we stand and it's easier for tax planning purposes. However, it does mean that as people's wages increase with inflation, a higher proportion of your wages will be subject to tax each year. So, without actually increasing taxes, the amount of revenue collected by HMRC will increase over this term. Worth noting that before 2031, we will have a new parliamentary election. So whether those thresholds remain frozen for the whole period is yet to be seen. But we can see that the basic band of deduction at 20% is up to that 37,700, making the higher rate threshold, including the personal allowance, around about £50,000, 50,270 it is. So again, if you're doing processing, that's about the threshold where you look at someone paying more than one rate of income tax. Our higher rate of deduction at 40% continues to go up to the threshold of 1,220. £125,140, and then above that we see the 45 pence per pound rate kicking in. The Welsh rate of income tax is the top 10% of each of those bands. The Welsh Parliament has the ability to reduce that down to 0 or increase it up to 20%. However, at least for the next financial year, that's going to remain at 10% as it has since the introduction of that devolution. So whether that will remain frozen for the same period up to 2031, we've yet to see. But for now, we're in a fairly stable place. The only place on income tax that we do see a change this year is in Scotland. So this applies to Scottish taxpayers that can sit on any payroll because it's based on your residence, not necessarily where you work. But you'll be able to identify Scottish taxpayers using, because they have an S, a prefix on the beginning of their tax code, and that means they are a Scottish taxpayer. In Scotland, there are considerably more bands of income tax. You can see 6 bands, in fact, and we see an inflationary increase to the starter and basic bands. So they are going up very slightly. So Scottish taxpayers are the lucky ones this year because they'll pay slightly less tax on their earnings than they did the previous tax year. For income tax allowances, other figures to be aware of, as I say, the personal allowance and in fact the limit for having a personal allowance remain frozen until 2031. So that's the threshold above £100,000, where for every £2 above that threshold you earn, you lose £1 of your personal allowance. So again, as wages increase, more people will be coming into this band of income. The only increases that we see this year are around the non-related thresholds to that personal allowance. So the married couples allowance, which is a legacy allowance and will mainly apply to pensioner payrolls, because it's only eligible for married couples, one of whom was born before the 6th of April 1935. So we're looking at 81 years old now. And the blind person's allowance is increasing very slightly as well. The impact on payroll is fairly minimal because these are individual allowances that will be included within someone's tax code. The 10% transferable marriage allowance isn't changing because the personal allowance isn't changing either. So that's the 10% that you can transfer between partners as long as one is not using them and the other is a basic rate taxpayer. And the dividend allowance, which was decreased to £500 last year, is continuing at £500 as well. Moving on to national insurance, another area where we see some stability, which is quite nice for national insurance after a couple of years of crazy changes. So the only change that we see when it comes to national insurance this year is the increase of the lower earnings limit. So that is going up from £125 per week up to £129 per week. So this has no impact on the calculation of contributions for national insurance. It really just has an impact on the trigger point at which someone starts earning towards their state pension credits, and the point at which someone becomes eligible for certain statutory payments. Now, we've got a lot to talk about when it comes to statutory payments, but I will cover that when we get to the statutory payments section. All other thresholds and reliefs are confirmed to remain the same this year. So we see the rate of primary deduction above the primary threshold, which is £1,048 per month, and up to the upper earnings limit of £4,189, remains at the reduced 8%, and then it drops to 2% after that threshold. And the much lower secondary threshold seems like it is here to stay at £417 per month. You can see the weekly and annual thresholds as well. The reliefs that are in place to encourage employers to hire certain groups of employees, for example, the upper secondary threshold for under 21s, apprentices, veterans in their first 12 months. A lot of these have seen extensions this year as well. So veterans relief, for example, brought in for a 3-year period, has now been confirmed to be extended until at least April 28. And we also see an extension to the geographic based ones, the Freeport and the investment zones. Those are also extended until the early 2030s. So again, we've got some stability here to make recruitment decisions, knowing what is happening. I'm going to actually also answer some of the questions as we go along, just so they don't get lost in the chat. So I've spotted Vicky's question around having to apply for the marriage allowance. So for the transferable allowance, Vicky, you do have to proactively apply for it, but it will transfer 10% from someone who isn't using their personal allowance over to the basic rate taxpayer to increase their personal allowance, meaning the couple pay less tax overall. The other marriage allowance, the legacy marriage allowance, is not open to new applicants. So it's only the transferable one that you can apply for. Hopefully that's answered your question. With all the different reliefs available now, so under 21s and veterans and so on, we see basically alphabet soup now where it comes to NI category letters. Many of them will not apply for standard payrolls. So it's about making sure you have checks in place to ensure that you're only using the NI category letters that apply to employee circumstances. The default is always A, and you can see most of the main uses are in this table. So make sure that you are selecting those. Again, I'm going to answer questions as we go through, just so I'm not moving on, but please save some questions for the end. I've spotted Sarah's question around what is deferred national insurance. This is the categories J and Z. These are for individuals who hold a certificate of deferral. So generally, they have more than one employment, and in their primary employment, they've exceeded the upper earnings limit. So they're already paying the reduced rate of national insurance in their primary employment. In that case, they can obtain a certificate so that in any second job, they can defer having to pay the band of deduction at 8% again in that second job, and instead they pay from 2% from the primary threshold straight away. Actually, you've reminded me to give everyone a reminder. If you do have any category J or Z employees on your payrolls, they do have to produce a new certificate every tax year. Otherwise, they're not eligible for those category letters and should default to category A unless another category applies. So do make sure for anyone that you have got that they give you a fresh certificate for the new tax year. The other letters, like I say, unless you are operating in a free port or operating in an investment zone, these letters will not affect you. So make sure that that you are monitoring that they're not being used incorrectly, or if they are relevant to your payroll, make sure you're selecting the correct category to receive that relief. Okay, I said we'd come to it. So our biggest change this year that will affect payroll is the changes to statutory sick pay. So there are two big changes from the 6th of April that affect how much sick pay you have to pay to employees that are eligible. The first thing that is changing is that waiting days will no longer need to be served for payrolls, for sick pay. So individuals with short-term absences can qualify from the first day of sickness. The normal rules for SSP, apply, So it must be a whole day of sickness, and they must be incapable of doing their work due to a sickness or um, another related reason. But they will qualify then from day one for a daily payment, potentially, of sick pay. The other big change is that we see the introduction of an earnings related rate for SSP. So, for sicknesses that begin before the 6th of April, there is a cliff edge for eligibility for a payment when you're sick. So, if you earn less than the lower earnings limit, which this year is £125 per week, you get nothing. And if you earn £125 and a penny, you will get the full weekly rate. From April, you will now, like we do for the first 6 weeks of maternity, you will now be entitled to 80% of your average weekly earnings, or the cap, the standard weekly rate, which is £123.25, whichever is lower. So we will see a higher volume of absences potentially being eligible for payment because you pay from day one. And we see low earners will now always be entitled to a payment related to their earnings. Um, it's not going to affect high earners as much because the standard weekly rate will operate in the same way. So we know that next year's rate is £123.25 per week. And when you are paying statutory sick pay, you look at their qualifying days that they have in any week. If they're sick for every qualifying day between a Sunday and Saturday statutory week, they receive that weekly pay. If they're only sick for some of their qualifying days in that week, then they're due a part week payment, which you can see on the table in front of you for the standard weekly rate is calculated based on the week divided by the number of days they could have qualified, and then multiplied by the number of days that they are due payment for. So someone who is working 5 days per week and is sick for 2 qualifying days in a Sunday to Saturday week, they'll be entitled to £24.65 per day times 2 days, which is the equivalent of £49.30 for that week. And again, that applies to beginnings and ends of sickness and so on. Some payroll software will be sophisticated enough to calculate this. Great. If you are doing any manual intervention, make sure that you're brushing up on rounding rules when it comes to SSP rates. For low earners that qualify for an earnings related rate, you'll need to apply this same logic. So divide it by the qualifying days, leave it in as an unrounded value up to 4 decimal places, multiply it by the number of days that they are actually sick in that week, and then round up any fraction of a penny in the employee's favour to arrive at how much SSP they are due. I'm going to come back to the more complicated questions actually towards the end. So I know I've answered simple questions as we've gone. I hope you'll bear with me that I will come back and answer those towards the end of today's session. So, as I've mentioned, so the overview of the changes, first of all, is that we are removing the waiting period. You will qualify for statutory sick pay from your first day. If you have any occupational sick payments, so company sick pay, just a reminder that SSP rules run underneath any kind of company sick pay policy. So make sure that you've considered whether any policy needs to be updated to reflect these changes. Because it's worth flagging as well, because of that waiting period now being removed, so you qualify from day one. When we deal with statutory sick periods, generally we're looking for either a continuous absence or linked periods of absence. So the rules say that if an absence falls within 8 weeks of the last time that you were sick, so 56 days, then those two absences are considered to be linked. And in effect, what happens is you pick up where you left off on the previous absence as if you hadn't returned to work. So you're entitled to 28 weeks of pay. So that 28 weeks will continue to count down in the linked period. And your rate of pay that was calculated for the first one will also continue in the linked periods. So just beware, because now you don't need to have that 4 calendar days in a row to form a period of incapacity for work that can be linked together. Even a single day of absence will potentially link sicknesses together. So if you do have a workforce with lots of short-term absence, make sure that that data is collected and recorded so that you can identify these absences, particularly for linking periods, because you'll need to know when SSP runs out, even if you're paying occupational pay. So that was just a warning. I know that went a little bit off piste, but I like to make sure you know about things to watch out for. The other thing to mention, just very quickly, normally with statutory pay, Northern Ireland has its own devolved employment law, so it lags behind the Great Britain with changes like this. Because this came from the Employment Rights Act directly, they've actually included links into Northern Irish legislation, so this will become effective in Northern Ireland from the 6th of April as well, rather than them having to introduce separate mirroring legislation. My last warning for you around SSP, we've covered what happens with brand new sicknesses that begin on or after the 6th of April. They will be eligible from day one at either 80% of their average weekly earnings or the capped weekly rate of £123.25. Great. We do have a period of transition over the change in rules, though. And there are 3 groups of employees that I'd recommend you look out for, even if your system is handling this automatically, just to make sure that they are picked up accurately. So your first group of employees to watch out for is those who are already off sick, but the reason they were denied SSP was because their earnings were too low. So these may be people on long-term sickness, or these may be absences that begin in March where their earnings were less than £125 per week on average. And so they were part of that cliff edge. They got no SSP at all. And potentially you have issued them with an SSP1 form already. They are not entitled until the 6th of April. And then on the 6th of April, you will start to pay them SSP. And the rate of SSP that you will pay them will be based on the 8 weeks before the absence began. So you'll have to go back in your records to identify the average weekly earnings that were too low, calculate the 80% earnings related rate, and then begin to pay that from the 6th of April. Because this can go back quite a long time, if you've got someone who's been sick for a really long time, there is in the guidance and in the regulations a cut-off. If they have been sick for longer than 28 weeks before the 6th of April, they will start to become entitled to SSP from April, but rather than having to go back 28 weeks and calculate the 8 weeks before that for average earnings, you'll be calculating average earnings before the 6th of April, which, because they've been on sick without SSP, means that their earnings will be calculated as 0 and they won't be entitled to a payment. That is just a backstop to prevent you from having to go back too far into records to identify these people that are due a new payment from April. And when they are due a new payment from April, they can be entitled for up to 28 weeks from that point because they've just started to be paid. They get their SSP payment. That's your first group of employees. So already sick, not receiving SSP, and the reason they were excluded was low earnings. By the way, these rules don't change any of the other reasons for exclusion. So being in your disqualifying period, claiming state benefits. So if they took that SSP1 form and started claiming employment support allowance, for example, they won't be eligible for SSP. There's more information about that in the guidance. I'll not go into it because it's quite niche. Our next group of employees that you'll have to pay attention to are those who begin a sickness period just before the 6th of April and who are serving waiting days. Again, your software might automatically pick them up, but if it doesn't, and they've only served one waiting day, for example, they will start to be paid from the 6th of April. Again, you need a trigger to make sure that they begin to be paid, and the rate of pay will be the £123.25 per week or average weekly earnings, whichever is lower, because they haven't already started receiving SSP. Our last group of employees to pay attention to, and this is only one job for April's pay effectively, but it is a job you need to make sure that you are handling correctly, is employees who are already receiving SSP, but who would be disadvantaged by this rule change because the rate of pay that they'd be eligible for this year is less than what they would have been eligible for in previous years. Now I'll go to a next slide to explain this in a bit more detail. These employees, because they are being effectively disadvantaged by the rules, the regulations introduce a period of transitional protection for them. It actually makes our job as payroll a little bit smoother because it means that anyone that's already receiving SSP will go up to the flat weekly rate this year. So we don't need to figure out 80% pay for anyone already receiving SSP. They will go up to the daily rate based on their qualifying days that was on that table that we looked at a second ago. You do need to identify employees whose original earnings, so their average weekly earnings when you figured out if they were eligible or not, fell between £125, enough to qualify, and £154.05. The reason is £154.05, 80% of that is £123.25. So this is the band of employees where if we put them onto what they're entitled to this year, they'd end up being paid less than that standard weekly rate. So they'll all go up to the standard weekly rate, but only for their current period of sickness. As soon as they return to work, they lose that transitional protection. And if they go off sick again, even if it's linked, they will go on to what they're now entitled to, the lower of 80% of average weekly earnings or the standard weekly rate. So that's two tasks there: identifying protected employees that need to be uplifted and making sure that your software is not defaulting them to an earnings related rate. And then secondly, identifying when they return to work that they're no longer protected and they go on to whatever their actual rate of SSP should be this year. Hopefully that all makes sense. Again, we've got a lot to get through, so I'm not going to spend loads of time on this. But if you do have questions, and I've seen quite a few come into the chat, I'll pick them up at the end of today's session, and you can ask as many as you would like. Moving on to other statutory payments. So the rate of pay for child-related leave is going up to £194.32 per week. As with SSP, the new rules, there is an earnings related rate as well. With this having gone up so much, it is worth just re-emphasizing that when we pay child related leave, it is always the lower of 90% of average weekly earnings or £194.32. So don't just default to paying that for paternity pay, for example. Maternity and adoption are the only two exceptions that get the earnings related rate, whatever it is, for the first 6 weeks, and then the cap applies of the standard weekly rate from week 7 onwards. We see, as I mentioned earlier, Northern Ireland has now introduced legislation that mirrors the statutory parental bereavement pay that was brought in 2022 in Great Britain. The difference this time, however, is that they've actually expanded the eligibility criteria for this leave and pay, if eligible, to include the loss of pregnancy, so before 24 weeks, so miscarriage, and to ensure that the leave is a day one right, so there's no service test to qualify for the leave. Because this is different in this legislation than elsewhere in Great Britain, it does mean that when you are processing payments for this leave, whatever the reason, if it is paid under a Northern Irish contract of employment, it has to be processed using the Northern Ireland statutory parental bereavement pay fields um, that are or elements in your payroll that are reported separately on the FPS. So the payment of it is reported using different fields from the Great British parental bereavement pay, and the EPS reclaim is also reported using different fields. So even if you don't have Northern Irish employees, make sure that you update your process notes to flag that if you are making payments of parental bereavement pay, the correct element and field should be used in your payroll. Carrying on with statutory payment, uh, even though the rules to SSP have changed this year, there is no reclaim available for sick pay. That is an employer only cost. We do see a reclaim available for child related leave. So for most employers, that will be 92%. For small employers, the threshold hasn't changed for what counts as a small employer. It is £45,000 or less in Class 1 national insurance in the previous tax year. But if you have any customers or you yourselves are a small employer, you can reclaim the whole amount of any child related statutory pay that has been paid out. And the compensation rate this year is increasing from 8.5% up to 9%. So you get to reclaim a little bit extra for having to make that payment in the first place. Moving on to student loans. So we see a change in student loans this year. Most student loan thresholds are increasing with inflation. The only threshold that we don't see an increase to is the postgraduate threshold, which is remaining at £21,000 as it has since it was introduced. So all of the undergraduate loans, Plan 1, Plan 2, Plan 4 are increasing. We also see the introduction of a new Plan 5 student loan. Now, I'm not going to all the detail. It is on the starter checklist. Which loan type or which loan plan an employee should be paying into, so which threshold applies, depends on where they did their studies and when. The new Plan 5 will apply to English students who began their studies since September 2023. So will be limited to just them that will need to repay under Plan 5. However, strangely enough, because the threshold is now the lowest of all the different plans, this will now become the default plan type to use when you don't have either a notification from HMRC or a signed new starter checklist. That will apply no matter where you are in the UK. So although only English students need to pay this plan, if you have someone who started without a new starter checklist and they are a Scottish resident, for example, they would normally be paying Plan 4, but you don't put them onto Plan 4, you will put them onto Plan 5 as the default. Again, once that submission is made to HMRC, they will send through a correction if needed for the plan type, but it is worth updating your processes to make that the default one, and make sure that you grab a new copy of the starter checklist, which includes that Plan 5 in the description for new starters to select. Redundancy payments. So the I'll not recap the rates of so how you calculate a redundancy payment, but it's based on length of service and age at that time of service. Generally, you calculate it using a week's pay from the Employment Rights Act, but there is a cap to the maximum amount of redundancy pay that can be due per week. That is increasing from £700 to £751 this year and £783 in Northern Ireland. On to minimum wage. So minimum wage rates are increasing across the board. Again, we see quite another year of big jumps to the minimum wage. The top rate, the living wage, is increasing from £12.21 up to £12.71 per hour, 50p jump. And you can see actually on the slide, that means that we've had a 20.6% increase to that top rate of national living wage since 2026. So a lot of employers are feeling the squeeze here, and it's worth noting that that has removed, for many employers that were paying above minimum wage rates, removed a lot of wiggle room when it comes to compliance with minimum wage for things like salary sacrifice schemes and so on. We'll talk a little bit more about that in a second. But absolutely, even if you think you're sitting comfortably above that rate, it's something to be paying attention to. Because of the intention to combine the age bands for national living into the single national living wage, we see a much bigger jump for the workers aged 18 to 20 and the workers aged 16 to 17 and apprentices. As you can see, that's gone up to £10.85 for 18 to 20s year olds and £8 for apprentices in their first year and workers aged 16 to 17. Quick reminder for minimum wage, the only thing that is not cash paid to the employee that counts towards the minimum wage pay can be accommodation. So if you are providing free accommodation, you get to add in an extra £11.10 per day to your minimum wage calculation. If you are requiring your employee to pay for accommodation, then that payment can be offset by £11.10 per day. Again, I'm not going to go into that in huge amounts of detail. For those of you who are already accredited, or who are thinking about accreditation with the Living Wage Foundation, last year the gap between the two was quite small, but we see a big jump to Living Wage Foundation this year. So the UK living wage has gone up to £13.45 and the London weighting for that has gone up to £14.80. To keep your accreditation, you need to comply with these rates by the 1st of May 2026. But if you are involved in that, it's a slightly different calculation for minimum wage and the rules are different. So make sure that you have checked that you meet all of the requirements for accreditation if you want to keep that. It's always worth, because we know the repercussions of not complying with the minimum wage, adding a couple of reminders of common pitfalls where it comes to non-compliance with the minimum wage. We've had a recent round of naming and shaming, which if you haven't seen, is always good practice to have a look at. What are the reasons that companies have found themselves in breach? Often, what we're seeing on the naming and shaming list is not necessarily intentional breaches, but often quite technical breaches. So payroll sits at the thin end of the wedge when it comes to compliance with the minimum wage. We don't have control over the whole process. It is a whole company process, but making sure that you're identifying risk areas is really useful and can help make payroll that kind of strategic partner. So things to be aware of, the rate change date. So minimum wage, the way it works is that the pay reference period has to be compliant. The employee has to receive enough pay divided by the time to be paid above an hourly rate. That hourly rate must be compliant with the old year's rates for any pay period beginning before the 1st of April. For any pay reference period beginning on or after the 1st of April, they must receive at least the new year's rates. What that means is if your weekly payroll, for example, includes the 1st of April, that's last year's rates it has to be compliant with. If your payroll, the weekly pay begins uh, Monday the 6th, for example, that's the New Year's rates. And also similar, if you are processing pay in arrears, it's the pay reference period. So when the earnings were earned, not the payment date that affects which rate you have to pay. Apprentices are always a common theme in non-compliance. So if you don't already have strict rules around checking apprentices on the minimum wage, make sure you do. It only applies to people who are on true apprenticeships, and it does not apply after the first year if they're aged 19 or older. So that's your first trigger, the end of the first year. Your second trigger is for anyone continuing on that apprentice rate. Once they turn 19, they then become eligible for their age-related rate. Minimum wage is a calculation, not a rate. So there are a number of different factors that can include or exclude pay, and deductions that can affect how much pay the worker is actually receiving. So when you are doing that calculation, make sure you're not including discretionary pay, so tips, gratuities, service charges, but also certain types of non-job related allowances. For example, they can't be included in your minimum wage pay. Car allowance is a great example of that. That is not minimum wage pay. Um, on the other side, I'm going to come back to salaried workers, deductions from earnings. Make sure that you've got good controls over deductions that are going through payroll. So anytime the employee is having to make a payment out of their own pay towards something they need for work, whether that's uniform, whether that's parking, whether that's meals, etc., that reduces pay for minimum wage in that period. Strangely enough, this can also be affected by payments that the worker makes outside of payroll. So if they are paying for their own black trousers, black shoes are really common in retail spaces. That can impact whether they've received the minimum wage or not. Salary sacrifice, I mentioned earlier, is a really key thing here. Salary sacrifice is not a deduction from pay. The employee agrees to be paid less in exchange for pension contributions or a bike under cycle to work. They can't agree to be paid less than the minimum wage. So when you're doing calculations, it is always the pay after sacrifice that counts, and it's the pay the worker actually receives. And just be aware of any kind of net pay deductions that are for the employer's own use and benefit, is the phrase. So £1 admin fee is a great example of this. You don't have to take it. So even though you are allowed to take it if you are processing attachment orders, it's the employer's decision about whether to apply that admin fee. And so therefore, even though it is a net pay deduction, it will reduce pay for minimum wage in that period. I said I'd come back to salaried worker hours. This is becoming a really common theme with HMRC, looking at workers who are classed as salaried, so where their contract is saying that they're paid in 12 equal instalments through the year, or 52 if they're weekly, and their hours, therefore, their annual hours, are also kind of notionally spread across the year. It can be really helpful for some organizations because it means that when you're doing minimum wage, you only have to check annual salary divided by annual hours. And it doesn't matter that February is a short month and March is a long month. So they're working more hours in March than they are in February because you're allowed to smooth it out across the year. That works fine unless you have workers who are regularly doing more hours than is in their contract. The reason for that is by the time you have exceeded those annual hours, all your remaining hours that you work past that have to be accounted for in the last few months of the year. And you also have to account for the 1/12 of your annual hours into that period as well. Often meaning you might have almost double the number of hours to have to account for in the last few months. I'm not going to go into, again, too much examples with this. If you haven't already come across this as a risk for minimum wage, do investigate it. It is something that is was on the naming and shaming list as the reason for quite a few breaches. So make sure that you're flagging this, because this quirk, this technical breach, can mean that even very well paid individuals will end up in breach if they're doing lots of extra unpaid hours. That's my little soapbox. I will step down now. Just make sure that you are checking that as a risk area. On to pensions, automatic enrolment really isn't changing this year much. So all the thresholds and earnings triggers are remaining the same. So £833 per month, £192 per week, and aged above 22 to the state pension age means that they are automatically enrolled into a pension. They're an eligible job holder. We have got, or the legislation has passed, that we know the lower limit for the qualifying earnings band is going to be abolished, which will mean in the future for minimum automatic enrolment pension schemes, contributions will be due on all earnings from the first pound of earnings. And we know that the age trigger will be reducing down from 22 to 18, again, to try and bring more young earners into saving for retirement. While we know that is coming and it's official legislative, it definitely is coming. This isn't speculation. We don't know a commencement date for it yet. So we don't know when it will come into effect. It won't be from 6th of April, we'd know by now, but it is absolutely one to factor into budgeting and so on for the next tax year, for the next couple of years. Moving on to company cars, so we see increases across the board to the appropriate percentage for company cars. As always, that's with the intention of driving individuals to choose greener cars, because when you calculate the cash equivalent for tax, we're looking at the listing price, the value of the vehicle, multiplied by a fraction, a percentage that you'll get taxed on each tax year. The greener the car is, so the less CO2 it emits, the smaller the percentage. We also see that for very low cars, tends to be hybrid cars that are emitting less than 50 grams per kilometre of CO2. They not only are calculated on the CO2 emissions, but they're also calculated on their zero emission miles, which is how far you can travel on a single charge. There is a situation brewing with the testing standard where it comes to these plug-in hybrid electric vehicles, PHEVs, because there is a new testing standard. We don't need to know that, that's car stuff. But it does mean that some vehicles already on the market that fell into this band of calculation for company car tax under 50 grams of CO2 are now testing above 50 grams of CO2. So let's say you had a car that tested at 48 grams. It means that if they could go really far on a single charger battery, say 100 miles, they might end up as a 7% per year cash equivalent. But now they're testing at 51 grams. And so rather than 7%, they will end up at 17%. It's not on this slide, but let's say that's the first band above the zero emission miles ones. So that's going to cause a huge jump in the car tax and the benefit in kind class 1A for these vehicles. So for a transition period up to 20 vehicles registered before 2028, these cars will be brought back down into this kind of way of calculating. But long term, you do need to be aware of this, that it will increase quite dramatically the percentage that needs to be processed, and by that point we'll be payrolling benefits as well. Just some figures for you here. So the company car fuel multiplier has gone up to 29,200 multiplied by whichever appropriate percentage the car has. Company car vans has gone up to 4,170. The flag this year is to make sure that anything you are putting through as a van is a true van. So primarily suited for transporting goods, not people. There have been cases around double cab pickups and things that are suited for both, which generally HMRC is erring on the side of it needs to be processed as a company car, not a van. So if that applies to you, do some extra research, and the van fuel charge is there. Very quickly, a couple of other things that we picked up from the autumn budget. The easements for being able to claim tax relief for working from home is ending from April. So this is the £6 per week that home workers can claim as tax relief through self-assessment if their employer isn't already reimbursing them for the increased electricity and water for working from home. The being able to reimburse your employees £6 per week as a flat fee isn't stopping. What is stopping is the ability of individuals to claim it through self-assessment. It makes sense. We kind of knew it was coming. So that has finished. The other thing that is slightly changed is the exemptions for certain benefits that are currently free to provide if you are providing them as a benefit. So small things like working from home equipment, accommodation for it says accommodation, but that's really just working. Co-working spaces. So if you're paying for someone to work in accommodation, not traveling accommodation, eye tests, flu vaccinations, and so on. At the moment, if the company arranges and provides them as a benefit, they are exempt. But if the employee pays for an eye test and claims it on expenses, it is not an exempt reimbursement as it stands. So that is now being brought into the same process. So from April, you can do it either way. The exemption still stands, which hopefully will make the administration a lot smoother for these types of minor benefits. I think the last thing to mention is tax advisor registration. If you are not already all over this, hopefully this is not the first time you're hearing about it. Pardon me, but payroll only service providers. So not those who sit within a larger accountancy practice, but if you are providing just payroll services and you are not already registered for an agent services account, you will need to register this tax year. You will also need to have anti-money laundering supervision, which can be done by HMRC, so you can apply for that. If this applies to you, make sure that you are getting the right information and starting to register from May. Registrations should be done by November, and there is only a 3-month grace period to February 2027. If you haven't already investigated this, it might take a while to just check what processes you need to go through. So make sure you are doing that. And then looking ahead, I'm really sorry, I'm conscious of time and I want to get to all of the lovely questions in the chat. So this might be one that watch this space for more information about. We know payrolling of benefits is coming from April 27. There is some guidance out there that was launched in November, but we haven't seen anything since then. It's gone a bit quiet. So we anticipate further guidance by the end of the year. Even if you are voluntarily payrolling benefits, just be aware that some of the processes will change from April 27, particularly around RTI reporting and the fields that you will have to use. Anyone that has loans or accommodation as well, they will not automatically move to mandatory payrolling of benefits, but there will be a voluntary system to be able to report them. We're looking for more details. The voluntary system should open in around about November. So just keep an eye on that. I'll not talk too much about the NI cap for NI relief on salary sacrifice pensions, planned to be £2,000, likely to be brought in as a requirement to process notional pay for class 1 national insurance in real time. What the mechanics for this look like, we don't know, but it's not coming till April 2029. So it's something to keep on the radar. Look at your contracts, look at how you use salary sacrifice for pensions and what the kind of affected population might be, but that's not something to do for next tax year. The same is true for self-assessment income. That is going to be, they're going to bring it into as much as real time as they can from April 2029, and the effect will be on tax codes and potentially increased queries from employees. So that was a whistle through the end of it. My final plea before I come to as many questions as I can get to is we have a number of different surveys open at the moment to try and gather information from the industry so that we can best represent the industry. If you haven't already fed into one or more of these surveys, would really, really recommend it. If you engage with them, your voice can be heard. There is a different survey for in-house payroll processes versus outsourced payroll processes, but we also have a survey around individual pay professionals. So please do make sure you check that out. And then, yeah, just a recap of the things to watch out for. SSP is your headline from this year. Tax advisor registration from November. Payrolling benefits from April 27 are your big things to look out for. So I'm going to go back to the beginning of the questions that I couldn't answer, and I will try answering as many as I can. Anything we don't get to, Ellie from Sintra has said that she'll gather the questions and we will try and get you a written FAQ response afterwards as well. So my first question is from Caroline, who has a casual payroll where people sometimes only work a couple of times a year as examiners. Can they claim SSP if they are sick, even if they don't have work assigned to them at the time? This is a really great question, and unfortunately the answer is yes. So under SSP rules, you have to have at least one qualifying day per week. And in the absence of an agreement between the employer and the employee, the default is one day on a Wednesday. So if your examiners who are still under contract are sick on a Wednesday, technically they could claim potentially a whole week's pay. Now, the average weekly earnings will be calculated in the 8 weeks before they were sick, and it will be payable at 80% of those average weekly earnings. So it should be a fairly minimal amount, but the payment could be due. And with them not having more than one qualifying day in the week, it might be a whole week's pay from day one from their first sickness. Hopefully that hasn't opened a can of worms, but I'll give you as much information as I can. Hannah, just to confirm that yes, the SSP rules change from the 6th of April on a daily basis, not the 1st. So any sicknesses beginning on the 1st to the 5th fall under last year's rules. How do we define qualifying days? I think I've answered that in general. So your two options for those who don't have fixed working patterns are either every day is a qualifying day, 7 days per week, but then you need to make sure you're gathering information about sicknesses because they might qualify on any day, or 1 day per week, a Wednesday if you haven't agreed anything else. But you are free to agree that with employees, and that's a good conversation to have to say, what will your qualifying days be? So I paid March payroll today and I have an employee off sick today. Do I have to pay them SSP in our April payroll? It is relating to the period of sickness, not the period of payment, Nicole. So you're looking at a March sickness would be under the old rules, and only an absence that begins on the 6th of April or later is the new rules, unless you're in those transition periods. So I hope that's covered. Got time for maybe 2 or 3 more. Anne asked, do linked absences need to be for the same reason? They do not. For SSP purposes, It's the timing of the sickness that says whether they're linked. One could be for a broken leg, one could be for cold and flu. If they fall within 26 days, 8 weeks of each other, they are linked for SSP purposes. And my last opportunity to answer a question is Heather, who's asked, we have employees who just work, say, 20 hours a week, but this can be on any day. We've always used 5-day weeks for all employees for SSP. Can we still use this rather than qualifying days? Yes, sorry, I do need to qualify. Um, Earlier, when I said every day is a qualifying day, you can limit it to, say, 5 days per week if those are the normal business opening hours. So if your business is usually closed on a Saturday, Sunday, then it's reasonable to make a casual worker 5 days per week rather than 7. But if in your scenario, Heather, you've said that they can work on any day. So it's likely if they can work Saturdays and Sundays, you'd likely have to make that a qualifying day for them. I hope that makes sense. Again, if you have any further questions, please do come to us. A quick plug for CIPP services. If you have specific questions like that around your services and you're not already a member of CIPP, it is worth getting membership just for access to our advisory service. You'll get a sensible answer out of them about what to do in certain circumstances. And they're lovely people as well, which is really helpful. So, right up to time. As I say, we'll try and get as many answers to you as we can. But thank you very much for having me. And I hope you have a wonderful day and take care, everybody. Thank you.